Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. We have a fascinating and a pretty conflicting stack of sources today. If you feel like the global market is having a bit of an identity crisis, well, you are definitely not wrong. Our mission this morning is really to deep dive into that tension. We're tracking what feels like two completely separate markets running at the same time. One seems fueled by just, well, pure AI euphoria, driving certain tech names way up. And then there's this other market battling relentless geopolitical friction and, serious worries about valuations that are pulling major U.S. indexes down.
That tension is exactly what we need to unpack. We have to figure out whether the momentum we're seeing is based on, genuine sustainable value creation, like building new infrastructure, or if it's maybe more like a massive, super expensive kind of zero-sum race where all this aggressive spending just becomes, well, self-destructive.
Yeah.
So essentially, we're looking at that trade-off between real economic stimulus and just competitive necessity.
Okay, let's unpack this then. And I think we have to start with the biggest headline driver right now. The truly astonishing rise of Chinese technology stocks, especially Alibaba. Sources like Bloomberg are showing us that Alibaba, that's ticker BAI, has become China's hottest tech name. I mean, it soared a mind-boggling 52% just in September alone, and that's a big reason why the overall Hang Seng Tech Index is apparently set for its 8th consecutive weekly advance. That's its longest streak ever, apparently.
Right, and the key story here, for you listening, is really about the narrative shift. This is a huge company, a $420 billion internet giant, right? But investors, they're not just valuing it on e-commerce sales anymore. As one fund manager put it in a source we saw, the investment community now views Alibaba more as an AI cloud infrastructure player. They're really trying hard to slot it into that high-growth AI category. And they're being fed some pretty aggressive claims to justify putting it there. Morgan Stanley analysts, apparently after the company's conference in Hangzhou, wrote that Alibaba's main AI model, the Qwen 3 Max, they claim it surpasses GPT-5 and Claude Opus 4 and ranks it among the top 3 globally. I mean, wow, that is a massive claim to be making right now.
It really is. And look, it comes with real investment, too. The news about their partnership with NVIDIA, that definitely reinforces the infrastructure view. And crucially, it still looks relatively cheap. We see Alibaba trading around, 20 times estimated forward earnings. You compare that to Amazon at almost 25 times, Microsoft over 30 times. So analysts are saying Baba's the best parallel to the U.S. hyperscalers over in China. That valuation gap, that's a huge lure for big money needing AI exposure. But hang on, even as the stock's booming, you can feel the skepticism, can't you? While China's tech is flying high, the U.S. market is showing serious nerves. Major U.S. indexes saw back-to-back losses this week, and big AI names, like NVIDIA and Oracle, they actually retreated. That kind of suggests U.S. traders are maybe taking profits, or just fleeing because they fear a bubble.
Definitely seeing some profit-taking, or at least nervousness.
But what really jumped out at me in the data was the caution around Alibaba itself. The short interest in Alibaba's American depository receipts, that's their U.S.-listed stock, it jumped this week to 6.8% of shares outstanding.
And that is significant. 6.8% is the highest short interest we've seen in over 5 years for Alibaba. So even with the stock up, 52%, there's a pretty substantial chunk of, let's call it smart money, betting against this AI rally lasting. They're basically questioning if those big claims, like surpassing GPT-5, can actually turn into real profits, or if this is just, a short-term FOMO rally, fueled by it looking cheap compared to others and some bold press releases.
Okay, here's where it gets really interesting, though. Let's use that skepticism to look behind the curtain a bit, specifically at the biggest AI deals happening in the West, because the way they're financed raises some of those exact same questions about real value versus, financial engineering.
Yeah, the huge OpenAI NVIDIA $100 billion investment commitment. That's probably the clearest example of this kind of circular financing model we're seeing. CNBC reported on the structure, and it's unusual. Okay, so it's a cash commitment, yes. But apparently, most of that cash is instantly recycled right back to NVIDIA. Why? Because OpenAI isn't actually buying the GPUs up front. They're leasing the necessary infrastructure over time.
Okay. So NVIDIA puts the money in as an investment, and then NVIDIA immediately gets guaranteed future revenue from that exact same money flowing back as lease payments. That basically turns NVIDIA's capital spending into guaranteed subscription revenue for them.
Exactly. And that leads us right to this crucial observation that analysts like Jamie Zakalik at Neuberger Berman are making. They called it the circular nature of this deal goosing up everyone's earnings and everyone's numbers. Now, it's very clever financial structuring, no doubt, but it does raise that big question. is this actually creating new economic value? Or is it just inflating the reported value within this kind of closed, dependent ecosystem? Some estimates suggest the cost is just astronomical, like maybe $35 billion out of a $50 billion data center investment goes straight into NVIDIA GPUs.
Wow. That sheer cost of compute capacity really makes Intel's recent moves fascinating, doesn't it? Intel, the beleaguered American chip maker, is trying this big comeback through its foundry strategy, making chips for others. And it's attracting these massive strategic investments, $5 billion from NVIDIA, a 10% stake from the U.S. government.
Yep.
And just this week, its shares jumped, what, 6.4%? On reports it's actively seeking investment from Apple. This isn't just random market trading. It feels more like a kind of geopolitical or strategic stamp of approval on their foundry plan.
Absolutely. It's more than just market sentiment. And then beyond the huge chip giants like NVIDIA and Intel, you've got companies like Micron. They seem like pure beneficiaries of just the underlying demand. Micron's stock is running higher based on, get this, a 46% year-over-year revenue increase. And that's apparently driven entirely by demand for specialized high-bandwidth memory products, the stuff crucial for AI data centers. So this AI arms race, it's just driving up demand for every single component in that whole high-performance ecosystem.
Yeah, the message is loud and clear. This AI race is incredibly expensive. What's kind of fascinating, though, is how this huge cost driver seems to trickle down into sectors that feel really far removed from data centers. Like retail. In retail, AI is being pitched purely as a cost saver. Morgan Stanley is really selling this narrative hard to their retail clients. We saw a report where they estimate that AI tools, specifically something called agentic AI, could represent wait for it, $6 billion total cost savings opportunity for America's biggest retailers by 2026. They think it could boost profit estimates by up to 20%, and they point it specifically to companies like Gap, Macy's, and Victoria's Secret as being best positioned.
Right, and the savings they're talking about, it's not really about glamour stuff. It's very operational. Things like better inventory planning, automating parts of the supply chain, improving demand prediction, which, cuts down on markdowns and waste. Those are definitely real potential margin boosters.
But the skepticism creeps in again, doesn't it? And it connects right back to our earlier discussion about market value and competition. Morningstar analysts, they sound pretty skeptical. They basically noted that if everybody has access to the same technology, which for the most part they do, then it's hard for anybody to really get any kind of edge. Okay, so if every single retailer implements this agentic AI, does it just become another expensive competitive necessity rather than a true differentiator that boosts margins long term?
And this brings us to a really crucial analytical concept that we need to define for you because it's being used prominently, especially in China. The term is involution. Heard of it? China is apparently actively tackling what they call involution-style competition, which is basically, it's self-destructive competition. It happens when there's excess capacity or when everyone adopts the same universally accessible high-cost technology, like maybe this AI. We see this concern popping up in their copper smelting sector, for example. Processing fees are apparently so low that margins are just getting crushed. The sources called it a prominent problem. And it goes further. Their commerce minister even urged Chinese firms operating over here in the U.S. to actively avoid price wars. So it's like a formal acknowledgement from the government that this intense, value-destroying competition is actually a structural economic weakness they need to manage.
Okay, so if we connect that idea of involution back to the U.S., when we talk about the circular nature of that big NVIDIA OpenAI deal, and we see the U.S. tech indexes retreating, you have to wonder if the U.S. market is maybe just describing involution. Use different words like bubble worry or froth. It sounds like the same fundamental concern. Companies spending enormous sums of money just to maintain their expensive position rather than actually gaining new ground or creating durable value.
It's a very real possibility. Is the spending productive or just defensive?
Okay, so we've got this clash. AI euphoria versus bubble anxiety in this involution concept. Now let's layer on the final, very immediate market risk we're tracking this week. Geopolitical actions that are surprisingly broad.
Yeah, we really need to focus on the expansion of the Trump administration's Section 232 national security investigations. Now, these probes, they traditionally focused on heavy industry, right? Steel, aluminum. But now they've been expanded dramatically. They now include imports of robotics, industrial machinery, and critically medical devices.
And when we say critical medical devices, we're talking about things fundamental to the U.S. healthcare system. Surgical masks, syringes, even diagnostic devices like pacemakers and insulin pumps. The fear rattling the market is that these investigations, which are launched under, national security pretexts, could lead to a whole new round of tariffs, possibly stacked right on top of existing ones.
And the reaction was immediate over in Europe. We saw European medical technology firms, big names like Siemens Healthineers and Convatec, their shares slid pretty quickly based purely on the threat of these potential new levies. The conflict here is just so immediate and direct. You already have hospital trade groups warning that, okay, the administration might be citing national security, but these potential tariffs, they will directly drive up the cost of healthcare. And that's a cost largely passed on to, well, the American consumer and taxpayer-funded programs like Medicare and Medicaid.
It really feels like the ultimate political and economic contradiction playing out right there in the headlines. And interestingly, running right alongside this trade friction, we saw market activity driven by other geopolitical shifts too. Global defense stocks, names like Germany's Rank and Sweden's Saab, they actually rallied significantly. And this was apparently after President Trump seemed to reverse his tone on Ukraine, suggesting now that Ukraine could recapture all its lost territory. So geopolitics isn't just a headwind, it's also a massive and frankly unpredictable market driver in both directions.
Absolutely. Huge swings based on rhetoric. And just to tie this back to the U.S. domestic market caution we were talking about, that caution is being echoed right from the top. Jim Cramer, as reported in the sources, mentioned he's becoming more circumspect about, quote, super speculative stocks. And he cited a very specific reason. Federal Reserve Chair Jay Powell's recent comment that, quote, by many measures, for example, equity prices are fairly highly valued. You know, when the Fed chair uses language like that, even the most aggressive traders tend to sit up and take notice.
Yeah, that's a signal you can't really ignore.
Ugh.
Okay, so let's try to wrap our heads around this. What does this all mean for you listening? We've seen this incredible, almost record-breaking AI optimism, especially visible in China right now. But at the same time, we're seeing very real-world signs of potential market frost, dependency issues in the U.S. tech sector, especially when you really look at how some of these massive deals are financed, that circular flow of cash. And then layered onto all that momentum are these new, very specific geopolitical risks, from the threat of tariffs on essential medical supplies to these regulatory efforts in China trying to actively stop involution.
Right. And if we connect this all to the bigger picture, it feels like the market is fundamentally trying to decide whether all this massive spending, whether it's on AI infrastructure or military preparedness, is ultimately an economic stimulus that actually pushes us forward, or if it's becoming a form of involution, a situation where the spending merely preserves everyone's competitive standing, but does so at an increasingly destructive cost, maybe even hindering real innovation.
That's a powerful frame. So here's a final thought for you to consider. You've seen how China is actively trying to regulate against involution, that fierce, self-destructive competition in industries like copper smelting. Now, considering the concerns we discussed about the circular nature of that huge NVIDIA OpenAI cash deal and the fact that U.S. tech indices retreated this week, how long might it be before we see major U.S. investors, or maybe even regulators, start to frame some of this aggressive market-driving AI spending here as potentially a form of involution itself? Could it be seen as something that actually limits real innovation in the long run rather than accelerating it? That is definitely something worth tracking. Thank you for joining us for this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.